Thursday, September 29th, 2022, Maneco 64, home of alternative economics and contrarian views. Well, big day yesterday. Today we're going to look at the consequence of the Bank of England's action and what I think that will be. I think it will be the destruction or the collapse of the currency, the British pound or sterling. And I think all the other major central banks are going to go down the same road. So that's what we're going to look at today. As von Mises called it, the crack-up boom, or you want to call it hyperinflation. Before I start, though, I'd like to talk a little bit about what happened yesterday and some other things. So I spoke about the gilt market yesterday. And I've been following it, of course, a couple of days ago on the 27th. So that was Tuesday. I even tweeted this out. Number 11, we have a problem. What's number 11? Well, that's the place where the Chancellor of the Exchequer lives. It's next to number 10 Downing Street. And I said UK 2-year gilt yield or cost of borrowing. And you can see how it spiked from actually negative in the beginning of 2021. It was, I think, in negative territory. And it was approaching 5%. Now the spike was massive. So, yes, it all culminated very quickly. But back to what I was doing yesterday. Yeah, I did my video. I've been warning people about this. And it hadn't happened yesterday. The Bank of England had not acted. It only acted after I did my video. And I went into town yesterday. I walked into town to have some breakfast. And luckily enough, I carry my Apple iPhone. And I got a notification from the FT about the Bank of England's action. And I thought, wow, this is huge. And it turned out to be huge. And I even tweeted out, oh yeah, there we go. I said the Bank of England has just pivoted and started, I wrote start, you can't correct your tweets, QE again, before even getting QT started. Hashtag hyperinflation, here we come. So that's what I thought about it. And yes, eventful day yesterday. It shows that how interconnected the whole world financial system is, because you might think, does the UK matter? But it does. It affected everything. It affected currencies. It affected the gold and silver price, and we're going to come to that in a minute. And I'd like to say to my viewers in North America that I have a new affiliation with Miles Franklin, and you can see below here how to get in touch with them. Am I pushing people to buy gold and silver? Not really. I've been talking about how gold and silver are important stores of value over the long term, how they're important as something outside the system that doesn't have counterparty risk, and we're going to look into that today. And I always tell people, do your homework, read up on the books that I talk about, and decide for yourself. But if you do decide to get some gold and silver, think about using my affiliates, because it helps the channel. Yes, I'm here to try to help people learn about what's going on and inform people, but I also need to make some kind of living. It's not a charity. And yeah, so there you go, Miles Franklin in North America. Of course, I still have my affiliations here in the UK with Gold Investments and Glint. And with that, let's get back to the Bank of England. Yes, I think it's a huge decision yesterday. And I think it answers the question of whether the central banks are going to pivot or whether they're going to allow everything to collapse in a deflationary collapse, at least for the Bank of England. But I think all these major central banks, they have the same game plan. They meet every other month, the central bankers in Basel, Switzerland, at the Bank for International Settlements, which is owned by them, and indirectly, of course, owned by the private banks. So that's the way I see it. And just wanted to show you some tweets here by Lawrence Lepard. And some of you have said to me, why don't you ask him to come on the channel for an interview? And I have contacted him. I haven't heard back from him. Hopefully I will. But he tweeted some interesting things yesterday or recently. The first one I wanted to show you is the percentage change in the price of gold during the Weimar Republic, during World War I, and then in the run up to the Weimar hyperinflation. And you can see how volatile it is. It's not gold that's volatile, it's the currency. It was the Reichsmark that was very volatile, and then it ended up becoming worthless. And if you had gold and silver, you were fine, or more than just fine. You had a lot of opportunities to accumulate in a very cheap fashion, assets that could make sure your family were comfortable for many years or even generations, I would say. So that's what I wanted to show you when people talk about the gold price going all over the place. It's more the currency. The other one, he just tweeted out, I think, late yesterday. Or actually, he's got it pinned. I'm sorry, and it's from 2019, and I thought this is good. It's showing what the problem is now. You've got debt going through the roof, and the economy not really following. So I spoke about that, the mathematics of everything, that the system will collapse one day because there's too much debt and the government becomes too big. And this one as well. He tweeted 7 hours ago, the Chancellor on brink, second bailouts for banks. Well, and this is from 2008-9 crisis. And now the pensions are on the brink, on brink of collapse, and so is the currency. And with that, I wanted to recommend a book that many of you have read before, but for the new subscribers, the new followers, it's a book that I read probably about 20 years ago, maybe a little less, and coupled with Bernanke's helicopter speech that he made in November, I think 2002, it really made me believe that this day would come. The fact that central bankers will have to hyperinflate everything. And it's this book here, Fiat Money Inflation in France, how it came, what it brought, and how it ended, by Andrew Dixon White. And it's a very short book, but the gist of it is that once you start down the road of inflation, you can't get out of it. And that's what they did in 2008 and 9. And most people, of course, think that inflation is just the CPI. And that's why I've been so adamant that people know the right definition. And here we are now, and the Bank of England has had to bail out the pension system. It's had to bail out the whole government bond market, for that matter. And you'd think that the savings or pensions, private pensions, would be safe, but they're not. You'd think that you have, let's say, £500,000 in there, and they're giving you 8% a year after you retire. And the 8% is important because that's what they guarantee you when you sign into the pension. That's what they guaranteed me back in the 90s. They said, when you retire, you're going to get an income of 8%. But the thing is, in the last 20 years, interest rates have been kept like almost at zero. So the only way that the pension companies, the pension fund managers could give the policyholders 8% was through leverage. And when you get the kind of leverage that we're seeing now in the safe haven asset, which is government bonds, everything unravels. And and it looks like the pension industry was in the brink of collapse yesterday, and they had to save it again. So I want to go into the crack-up boom now, because I said in the beginning of the video that the Bank of England is guaranteed that the currency is going to collapse. And by collapse, I mean its purchasing power is going to go almost to nothing. You won't be able to get much. Yeah, your pension was saved yesterday, but in 5-10 years' time, your monthly income from your pension might only buy you a Starbucks coffee, maybe a small one. They call it the tall latte. It won't buy you a venti or a large latte. That's the way it's going to go. There is consequence to everything. Yes, the Bank of England said they're only doing this for until the 14th of October, and that on the 31st of October, they're going to start doing quantitative tightening. I mean, that's just talk. I said, I think last week, because they've been saying since the beginning of August that they're going to probably start QT, and they said in the next month, beginning of September, and here we are, and they're doing QE again. If you believe the Bank of England, I've got a bridge to sell you, so the old saying goes. But I've got this in my system here. I wrote this up. I took it from Human Action. So let's go through what the crack-up boom is. But then finally the masses wake up. They become suddenly aware of the fact that inflation is a deliberate policy and will go on endlessly. Well, we've got the government spending like a drunken sailor, quasi-Kwarteng, or some call him Kami Quasi. And we've got the Bank of England now inflating to save everyone and everything. A breakdown occurs. Well, that's when the masses realize. Right now, you and I have realized it. So it should give you an advantage over the masses, I would say. The crack-up boom appears. Everybody is anxious to swap his money against real goods, no matter whether he needs them or not, no matter how much money he has to pay for them. Within a very short time, within a few weeks or even days, the things which were used as money are no longer used as media of exchange. They become scrap paper or scrap digital entries. I put that there. Von Mises didn't talk about that when he wrote this. Nobody wants to give anything away against them. It was this that happened with the continental currency in America in 1781, with the French mandats territoriaux in 1796, and with the German mark in 1923. It will happen again when the same conditions appear. If a thing has to be used as a medium of exchange, public opinion must not believe that the quantity of this thing will increase beyond all bounds. Inflation is a policy that cannot last. So Human Action by Ludwig von Mises, page 428. Yes, that's where I think we are right now. And at least here in England or in the UK, the Bank of England has chosen the crack-up boom. And of course, they're not going to say they have. They're going to try to keep you in the game. And so yesterday could have been the day that many people who depend on these pensions would have been wiped out. And can you imagine if you didn't have any other savings? You would be destitute. And that's why I think it's so important to have some of these here, and silver as well. And what are these? Well, these are 40 francs, Napoleon francs. And you might think, why Napoleon? Well, just to show you here, there's a passage in this book towards the end, and I'll read through it. At the first cabinet council, Bonaparte was asked what he intended to do. Well, this was after the collapse of the assignats and the mandat territoriaux, which are paper money. And this is what he said: "I will pay cash or pay nothing." From this time, he conducted all his operations on this basis. He arranged the assessments, funded the debt, and made payment in cash. And from this time, during all the campaigns of Marengo, Austerlitz, Jena, Eylau, Friedland, down to the Peace of Tilsit in 1807, there's but one suspension of specie payment, and this was only for a few days. So, and you might say, well, he said he was going to pay cash, not gold. Well, back then, cash was gold or specie. So that's where we are right now, and I think the Bank of England has given us another opportunity to protect ourselves. If they hadn't intervened yesterday, everything would have, I don't know what would have happened. It would have been very serious. So with that, let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. Yes, gold and silver rallied strongly yesterday. I think silver was up 3% in dollar terms, and gold was up 2%. We are back down a little bit now, but as I said, and as I showed you from that Lawrence Lepard chart, the currencies are getting very volatile, and it makes gold and silver look volatile. But it was good enough for Napoleon, though, I would say. So we got spot gold at 16.44, is down about $16. High's been 62, low 41. Silver's at 18.57, down 30 cents, 1.6%. High's been 18.98 and the low 18.55. So the relief rally we saw yesterday, we saw the dollar go down, euro and the pound rally strongly. It's been given back today. The futures, the Dow futures is down 1%, 310 points. The NASDAQ is down 158 or 1.4%. S&P futures down 1.2% or 45 points. The FTSE is down 125 points, almost 2%. And now to the currencies. Sterling is back down today. It's down 1% at 107.76. Just a little observation about sterling and the talk of parity, and if it breaks parity versus the dollar, it will be a disaster. Well, I think the most important exchange rates for us to have in mind, not just of the pound, but of the euro and the dollar, is the exchange rate to gold. I don't think the cable or GBP USD exchange rate is that significant in terms of the value of the currency. What we need to keep an eye on, of course, is the exchange rate between gold and the pound. How much gold is the pound going to be buying forward? And I don't think it's much. So that's the most important exchange rate. We could hold here about above parity, the cable rate, but if we see gold going through the roof, that's just as bad. It's even worse, because gold is the ultimate arbiter of value through the millennia. You can't argue with that. It's not Bitcoin or the paper dollar. So the euro is down about 1% as well at 96.46. The dollar is up 1/3% versus the yen, 144.60. The dollar is up actually 0.8% versus the Swiss franc at 98.40, and the dollar is up 0.7% versus the yuan at 721. Let's have a look at the ruble. Well, the dollar is up about 2/3% at 58.50 versus the ruble. To the other currencies, we got Aussie dollar down 1.1% at 64.48. And we've got the dollar up 1% versus the loonie at 137.40. And we've got the Kiwi dollar down 1.25% at 56.55. To the general commodities, WTI crude is down 1.8% at 80.40. Brent is down 1.7 at 86.55. And high-grade copper is down 1.3% at 331. U.S. nat gas is up 0.2%, just above 7. And let's check the Dutch TTF nat gas futures. That's down 2.5%, just above 200 at 202. So yes, of course, the bond market yesterday rallied massively, especially the gilts. So yields dropped. The 30-year went from around 5.13 all the way below 4%, mainly because the Bank of England intervened. And how do they intervene? Do they use dollars? No, they don't need to use dollars because gilts are denominated in pounds. All they do is they conjure up billions on the keyboard out of thin air. You can call it reserves, and they buy these government bonds. So basically they're monetizing the debt, the government's debt, indirectly, of course, because they buy it from the market. But it's as good as, and that my friend, is hyperinflation. So right now the 30-year yield is up 18 basis points. So a lot of volatility. It's not going to help the pensions nor the markets. It's back above 4%. It's at 4.10. So that's the gilt market. What about treasuries? Even the yields there dropped like 20 basis points across the board. And that's because of the Bank of England's actions. And you can see how intertwined all these markets are, especially the city of London and New York. But this morning we're back up about 15 basis points across the board, and the 10-year is back to 386. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide, and think about subscribing to my channel as well if you haven't yet. And with that, I wish you all a great rest of the day. Take care. Bye.